So Carvana just dropped its Q4 2025 earnings, and honestly, it created one of the biggest puzzles on Wall Street. You look at the numbers, and it seems like the company's absolutely crushing it. We're talking incredible, record-breaking results. But then you look at the stock, and it's a completely different story, a massive sell-off. So what's going on here? In this explainer, we're going to unpack this paradox. How does a company report such amazing growth and still watch its stock take a nosedive?
Okay, let's kick things off with Carvana's big headline numbers, because on the surface, they look incredible. For the entire year of 2025, they pulled in a staggering $20.3 billion in revenue. I mean, that's a 49% jump from the year before and a brand new record for the company.
And that revenue wasn't just pulled out of thin air. It was driven by a huge increase in the number of cars they sold. We're talking nearly 600,000 cars in 2025. That's a 43% leap year over year. It just goes to show you there is massive demand from people for their whole online car vending machine model. People are clearly digging it.
And if you zoom in on just the last quarter, the story gets even crazier. Their Q4 revenue shot up by 58% compared to the same time last year. Now, just to put that in perspective, the rest of the used car industry was pretty much flat. So Carvana isn't just growing, they're growing at an absolutely blistering pace. So you'd expect the CEO, Ernie Garcia, to be pretty happy, right? Well, he was. He painted this picture of a company just firing on all cylinders. He highlighted the growth, sure, but also better economics and more value for customers. He even said that doing all of that at once is a rare thing, basically hinting that they've really hit their stride. Everything sounds fantastic, doesn't it? Record revenue, record sales, a super confident CEO. And that's what makes this whole thing so weird. It sets up the central mystery we're trying to solve. If all the news was so good, what on earth happened next?
Yeah, this happened. Despite all those record-breaking results, Carvana's stock absolutely plunged, dropping by as much as 20% right after the announcement. The market's reaction was swift, it was brutal, and it left a lot of investors just scratching their heads, asking, wait, why?
All right, to figure this puzzle out, we have to do what all the Wall Street analysts did. We have to look past those shiny headline numbers and really dig into the details of the report, because that's where this story takes a very, very different turn.
First things first, we need to talk about a bit of Wall Street jargon that was right at the center of the market's freakout: adjusted EBITDA. It sounds complicated, but it's really just a way for companies to show how profitable their main business operations are, without all the noise from interest, taxes, and stuff like that. For a fast-growing company like Carvana, it's a number that analysts watch, like a hawk.
Now here's where the plot thickens. You can see on this chart, Carvana actually beat expectations on revenue and on earnings per share, but the one number Wall Street was really focused on, that all-important adjusted EBITDA, was a miss. They brought in $511 million, but the analysts were looking for almost $540 million. And for a company that's valued on its future profits, even a small miss like this can be a huge red flag.
But that EBITDA miss, it wasn't just some isolated issue. It was more like a symptom of some deeper worries that were hiding just under the surface, maybe pointing to some cracks in the company's foundation.
Another number that got analysts worried was the gross profit per unit, or GPU. It's pretty simple. It's how much profit Carvana makes on each individual car it sells. And as you can see, that number was moving in the wrong direction. It slipped from over $6,600 a year ago down to just over $6,400. That suggests their profit margin on their main product is actually shrinking, even while they're selling more cars than ever.
So, why was profitability slipping? Well, during the earnings call, management talked about what they called execution hurdles. The CEO himself, Ernie Garcia, admitted that their expenses were higher than they wanted, and he pointed right at the costs of reconditioning all those used cars. In short, their crazy growth was starting to get really expensive.
And as if all those internal challenges weren't enough, to add fuel to the fire, Carvana was also dealing with a major attack from the outside that really shook up investor confidence right before they released their earnings.
A very well-known short seller, Gotham City Research, published this report with some really serious accusations. They accused Carvana of using tricky accounting, claiming the company was using deals with private companies, ones controlled by the CEO's own father, to hide expenses and make their profits look better than they were. These allegations just created this huge cloud of doubt and mistrust around the company's numbers. So how did Carvana respond to this? Well, on the earnings call, CEO Ernie Garcia came out swinging. He directly and very publicly denied the main claim from that short seller report. His statement was simple: we don't sell loans to related parties.
It was a flat-out rejection of Gotham City's whole theory, and it basically set up a classic he said, she said battle.
All this disagreement leaves us with two totally different, competing stories for Carvana's future. You've got the bull case, which is all about unstoppable, disruptive growth. And then you have the bear case, which is focused on what they see as a really unstable financial house of cards.
The bull case is all about this chart right here, which actually comes straight from Carvana. It shows their massive 43% growth compared to the old-school used car dealers who, well, they actually shrank. The argument here is simple. Carvana is the future, a tech disruptor that's just stealing market share and is going to dominate the entire industry. They're eating everyone else's lunch.
But then you have the bear case, and they're saying not so fast. They argue that all this amazing growth is built on a really shaky foundation. They point to those weakening profit numbers we just talked about, the GPU and the EBIT to miss. They highlight the serious accounting allegations that create distrust. And some analysts think Carvana is having to give loans to riskier borrowers just to keep that growth engine firing. All of this while the stock is priced for perfection, leaving zero room for error.
So with these two completely opposite stories, what happens next? What should we actually be watching for to see which side of this debate wins out?
Well, analysts are basically zeroing in on these three key things. First, can Carvana get a handle on its reconditioning costs and get that profit per car number moving up again? Second, are their big investments in AI and automation actually going to pay off and make them more efficient? And third, can they keep up this incredible growth without killing their profitability? How they answer those questions will probably decide the company's fate and really shape what the future analyst predictions look like.
And that really leaves us with the ultimate billion-dollar question, not just for investors, but for the whole car industry. There's no doubt Carvana has changed how people buy cars. But everything that happened this quarter forces us to ask, is their high-growth, tech-first model a sustainable revolution? Or is this the moment where the financial reality of it all means the wheels finally and completely come off?